Hey, what's going on guys? It's your boy Freddy. Welcome back to the channel. Today I want to go over 3 Canadian dividend stocks that I believe offer good buy opportunities for long-term investors. Taking a look at the market today, we can see that most of the market has started to recover, with the main indices fully recovered from the fears that we saw at the start of the month regarding inflation. There was a lot of panic in the market as people were not confident that the Fed could keep rates low, as people saw many major indications that inflation was not only coming but already here. This was seen in the used car market, timber, and the price of housing. However, with CPI data showing that most of these inflation concerns are as a result of only a few industries and not representative of the overall market, many people started to buy back in, leading to the last couple of weeks where we have seen a lot of green all across the board. However, given all of this good news, there are still many Canadian dividend companies that are either discounted heavily or offer a lot of room to grow into the future as we start to see a reopening in the economy. I recently made an update to the Wealthsimple dividend portfolio, but if you guys haven't checked it out, basically my goal on Wealthsimple is to buy solid growth and dividend companies that offer a lot of high yield and are very fundamentally strong, in the hopes that I can slowly add into them and build a very strong portfolio that I can hopefully draw from when I retire. The plan is to consistently add to the portfolio over the coming years with the goal to share my journey with you guys. So if you guys are interested in seeing more videos like this, make sure to like and subscribe. Now let's get right into the analysis. The first company that I want to go over today is Canadian National Railways, ticker symbol CNR.TO. This is a transportation and rail giant that has a network of more than 19,500 miles of track all across Canada and in the US. They transport everything from oil, grain, minerals, forest products, chemicals, the list goes on. Because of the insane costs of setting up a rail system and infrastructure, the barrier to entry into the industry is very high, and therefore there are only a few major competitors in the industry. Furthermore, rail transportation is very efficient at transporting a lot of cargo over long distances, as the efficiency of steel-on-steel travel is almost unbeatable. This company also offers a lot of vertical integration, as they have various docks across the continent, and they also provide logistics services, transloading and distribution services, and have a fleet of semi-trucks to help transport in and around cities and over short distances. I am a big fan of CNR and the future that they offer, as their demand will only continue to rise as transportation needs will always be necessary. They will continue to get even more efficient as autonomous trucking and rail continue to see technological advancements. Looking at the recent earnings, at first glance, it may seem that the company is not growing compared to last year, as revenue, operating income, net income, and basically most major measures were even, and some were slightly down compared to last year. However, we realized that these earnings from this time last year showed that the company had basically no hindrances when it comes to the worldwide health illness that shut down basically everything all over the world for a couple months. Given that most of the major lockdowns took place at the end of March and early April, the earnings from this time last year were basically unaffected. That means that their earnings for this quarter were very promising, as it shows that the company has almost returned to their pre-illness levels. Looking at CNR's stock price over the last few months, we can see that it has basically fallen off a cliff since about the middle of April. This stock does tend to see a few dips every few months. However, this most recent dip does look more concerning, as they had breaking through their previous support levels. The reason for this dip has to do with the recent bidding war for Kansas City Southern, which is a major rail company in the US that has a network of rails all over both the US and Mexico. KCS plays a major role in the US-Mexico trade, and if acquired by CNR, it would link the company through the entire continent, creating an even larger network for freight cargo for the company. You may be wondering why the stock is dropping off so massively if this merger offers nothing but upside, as the company will grow massively and increase its reach. Well, it has to do with the fact that CNR is paying an absolute massive premium for the company. Even after the stock has risen over 45% over the news of the potential merger, they are willing to pay $33 billion, which is $6 billion more than the market cap of the company. I believe that a more fair valuation for the company is closer to $21 billion, meaning that CNR is paying about a 55% premium for the company. The reason that they are willing to pay so much is because of their ongoing bidding war with Canadian Pacific Rail, CNR's largest Canadian competitor. Both CP and CNR are willing to pay the premium for the company, as they do not want the other to acquire KCP, as it will make the company that acquires KCP a larger threat than they already are. It makes sense that CNR stock has dropped heavily, as analysts and the general investor community are easily recognizing that paying such a heavy premium for a company that is the smallest major rail system in the US is quite ridiculous. However, the reason I believe that this is actually a good deal for the company is because of what Kansas City offers to CNR. This merger could be very lucrative for CNR as it perfectly links Canada, the US, and Mexico in harmony while basically not interrupting their current operations in any major way. I believe that analysts and investors are far too overly negative when it comes to the merger because they are not looking at the long-term and bigger picture. On paper, this investment does look like they are paying far too much for the company. However, to CNR, the value of KCP is more than what their numbers tell, as their rail system fits in perfectly with what the company needs going forward. Canadian Pacific simply does not have the equity necessary to keep up with CNR in this merger, and them backing down was inevitable. In my eyes, this merger offers an amazing buying opportunity for the company, and I will be definitely looking to increase my exposure into it, and I've already bought a couple shares and will be looking to buy a couple more in my Wealthsimple dividend portfolio. Because CNR had broken through its previous support levels, I was waiting to see some more consolidation before buying heavy. However, we can see that over these last few days, the stock has absolutely rebounded in a major way, gaining 1 to 2% almost every day, and I now believe that most of the negative news is behind us and will now be looking to buy heavily. The second stock that I want to go over is Restaurant Brands International, ticker symbol QSR. As things are opening back up and we're heading back towards normal life, this is one stock that I couldn't miss mentioning. This has been on my radar for some time now, as QSR owns 3 popular fast food chains: Burger King, Tim Hortons, and Popeyes. My thesis on this is pretty straightforward, and that is that coffee and chicken will always be in demand. And if you are from Canada, you know that there is a huge population who can't go without their Timmy's coffee even for a day. Needless to say that they are an essential business here in Canada. Not to mention Burger King, which is world renowned, and of course Popeyes, which is an immensely growing restaurant that has a lot of people going crazy over their chicken sandwiches. A little bit of history about this company is that it started off as just Burger King, and then they acquired Tim Hortons in 2014 for $12.5 billion, and then in 2017 they acquired Popeyes for $1.5 billion, which at this point looks like an absolute steal of a deal. In 2019 they did about $5.6 billion in sales. That number dropped by $600 million to $4.9 billion in 2020, and of course this was definitely due to the pandemic. As far as revenue stream goes, Burger King makes up about 32% of the sales for Restaurant Brand, and Tim Hortons makes up about 57%. Tim Hortons experienced a massive drop in sales of about $500 million from 2019 to 2020, and this is pretty understandable in my opinion, as this was due to a drop in breakfast crowds. Because the majority of people are working from home and people are no longer grabbing their morning coffee and bagel as they head to work, I think this is definitely a factor that affected their sales and earnings. Now, Popeyes only makes up about 11% of their sales and revenue. However, these guys are growing at a very quick rate. To get an idea, Popeyes did about $200 million in sales in 2017. Then they reached $560 million in sales in 2020. And if you're not familiar with Popeyes, they do fried chicken, chicken sandwiches, and basically everything to do with chicken. There's also good news coming from CEO Jose Sil. He said that technology is a key priority for us, and in regards to Tim Hortons, he said that they were using about 40-year-old coffee brewing technology with a non-filtered water, and they basically changed that recently and are now focused on making the coffee taste better and the snacks and baked goods more fresher. In regards to Burger King, he said that they are working on their breakfast menu and investing in that heavily, and are also working on quality. They also just released the no artificial ingredient Whopper, and they are trying to get better quality meat in the burgers. And all of this does sound pretty amazing to me, but also makes me wonder what I've been eating all these years. Another interesting thing that he mentioned was now there are over 100 Tim Hortons locations in China, and they also opened their first one in Switzerland. It is good to see that they are growing all over the world, and I see much more growth in the future. The valuation right now is a bit expensive, so I would be looking to buy more on a dip. However, their dividend is also very intriguing. Right now they pay about 3.18%, which translates to roughly $2.60 per share, and their dividend has been growing year over year. To summarize, I agree with the direction of management and where they want to take the company as they invest more and more into tech. They're wanting to try out digital drive-through boards. They're rolling out more and more loyalty programs and apps. An example would be the Timmy's app, which has the Roll at the Rim program, which is now completely digital. And I think all of this will come at a cost of more and more short-term expenditures, but will pay out in the long term. So currently they're priced at about $83, is a bit too rich for me, but I will be watching them closely and looking for opportunities to get in. I'm thinking under 75 is a decent deal, and under 70 is definitely a buy. This is a very solid company that you can buy and hold over the long term. And like I said, these companies are a very strong staple in the Canadian culture, as people will always be drinking coffee and will always be eating chicken. The final company that I want to go over today is Ryocan, ticker symbol REI-UN. For anyone looking to get into the real estate market, the Ryocan REIT can't be ignored. Ryocan took a massive hit during 2020, as this was due to the commercial segment of Ryocan's portfolio, with malls, retailers, and gyms having to close up shop. So when these companies looked like they couldn't pay their rent and Ryocan's cash flow was in jeopardy, they were forced to cut their dividend by 33%. However, they were able to stomach the pandemic very well, and now that it's looking like it's behind us, I see Ryocan as an amazing opportunity with a lot of upside. I'm very bullish on Ryocan, and my reasoning for this is simple. As of late, Ontario, which houses the bulk of Ryocan's assets, has been on an absolute tear. The real estate market has been climbing and climbing, and with Ryocan, you are buying a company whose core model is to buy and rent out real estate. So this is an excellent way to get exposure to this market. The second reason I'm bullish is because of low interest rates. As we know, low interest rates favor real estate, as these big companies can get access to a lot of equity for very, very cheap, and Ryocan is in a prime position to benefit from this. The third reason I'm bullish on Ryocan is because of the uptick in immigration. You may be wondering why immigration would matter so much. Well, it has to do with the fact that Canadians don't have enough babies. And when you don't have enough babies, there become gaps in the labor market, and the only way to fill those gaps and for Canada to remain competitive on the world stage is to allow skilled workers to immigrate and fill those gaps. This is why for 2021 to 2023, Canada plans to have an immigration rate of about 1% of the population, or roughly 400,000 new permanent residents each year. And the majority of these immigrants are going to be looking to live in the GTA, and this in turn increases the need for Toronto to have more residential buildings. So massive immigration is coming. Add that to the already hot market in Ontario, you have real estate that can't really go anywhere except for up. Ryocan has a massive residential real estate portfolio and are looking to pivot more away from retailers and more towards the residential side. And this is a move I can get behind and I can put my money into, as I believe that residential real estate offers a lot of stability and offers a lot of growth. Looking at their current stock price of about $21, we can see that they are still a ways away from their pre-pandemic levels of $27. And I see this as a very, very solid return, as it's looking more and more stable that the company will reach that level as we exit the pandemic. And their monthly dividend is also very phenomenal, as they have a yearly rate of 4.5%. Well, those are the 3 Canadian dividend companies that I'm watching for this month. Let me know in the comments down below what you think and what you're watching for the month of June. And also remember to hit that like button if you enjoyed, and remember to subscribe for more investing videos like this to come. I'll catch you guys in the next one.